Hi, I'm Mark Roseno, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have our FSC show today, and before we get into it, again, to support the channel, please like, share, subscribe, share it with whoever you can. It helps us, keep things moving and keep the channel growing. I know it's dense, but there are people out there that do enjoy the data. At least that's what I tell myself, to keep things moving and to keep my motivation high. Let's put it that way. So before we get into it, we want to talk about, we're going to go through the FSC show and the count and want to look at that. And then we're going to do a quick catch up on where U.S. inflation came. And then just a brief update on some of the geopolitical situation that continues to arise. Unfortunately, I was not able to assemble the Libya piece, so I promise I will get to it. I will do it next week to make sure that, just to give you some of that updates. But again, we do have a very good backdrop. Previously, on when we did it, I believe it was in October of 2020, as well as in April of 2020, but I'll put those links in again. So with that being said, getting to the Primary Vision Frac Spread Count, it came in at 295. So we went up by 4. This isn't surprising. So for those that have been watching us, I've been saying that there's a lot of seasonality that comes into play here. This is that seasonal bump. We should be able to get to about 300 by the end, really within the next week or two. And then we'll have that for a couple weeks, and that will lead to the holiday slowdown. We had increases across the board. There was actually only 2 places that had declines, but they were all small. The main move is shifting higher, and they're in all the key areas, especially one of the big ones, which we've been talking about, is Appalachia, which is seeing that increase. But if you think about structuring, you normally sell fall and buy winter when you're looking at the E&Ps, just because they typically start to ramp up as we start heading towards the winter months. So nothing too crazy with here, things are moving fairly steady. And then when you look at the rig count increased by 7. So oil increased by 8, gas came down by 1. But all of the additions were in the horizontal space, and now we're at over 700. And this is where I think we continue to see a lot of this growth when you're looking at the horizontal side, as the horizontal, again, shifting higher, moving forward, and we're getting a lot of that strong momentum. And just given where things are going and how things are continuing to progress on the upside, that's, again, when you look at rig counts, again, it's trying to flatline, keep those drilled but uncompleted wells, those DUCs available for the frac spread to continue to run. And that's, again, setting up well, not only into year end, but also for a strong start in 2023. And if you just look at where prices are, obviously they've come down today, but just given the backdrop, there's still a lot of reasons to continue drilling in the U.S. Now, another one, when you look at just where diesel and gasoline prices are, you can see that diesel prices have continued to go higher. The average diesel price is now at $5.21.5. So it even moved up from when we talked about it in the EIA show. Diesel and distillate in general is where we are going to continue to see a lot of that upside that we continue to see, with gasoline hanging in at around $3.90. So the one that we focus on the most is really going to be that movement that we expect to continue on the diesel front. Now, before we get into some of the other pieces of the data sets, we wanted to talk quickly about Soleimani. And again, that was the individual that the U.S. was able to eliminate when you're looking at the U.S. strike under President Trump. Now, one of the things that we've talked about, and we did a lot of shows on it, and we did a write-up regarding why this was a positive when you're looking at a big positive for the U.S., but also for the Iranian people, just given his ability to squash uprisings, protests. And now with him not in the picture, you're starting to see a bit more of let's just say that a belief that things can change. And there are billboards of him throughout Iran, and they're actually now being set on fire by the protesters. And again, that you're starting to see this build. And as we talked about, and we did this whole breakdown last year in one of our free content about Iran, was that they were getting close to a government pivot. And now, again, for those that have been doing geopolitics for as long as I have, can agree to, it's near impossible to say, oh, there's gonna be an uprising and there's gonna be an overthrow this year. Again, these things take time. You'll have spits and starts, but we're starting to see a lot of this, I think, momentum really sending things higher, and that's gonna be an important one to watch as we progress into year end, but also as we head into 2023. So now when we just pivot back to the US data, I think one of the key important pieces is that real average hourly earnings and wages. So on the nominal side, nominal wages, and this is all going to be in our insights in greater depth, but so nominal wages are actually down. So they finally came down, but then if you look at hourly earnings, they are accelerating to the downside. So month over month, they're not only just year over year, but month over month they're coming down. And this is coming on the back of increasing inflation, accelerating PPI, and now slowing nominal wages, which again is going to make that worse. Now, when you look at retail sales flatlined. They were expected to be up 0.2%. They were up. They were flat. When you look at control group, expected to be up 0.3, came in 0.4. This is the last push that we talked about in September. October is where we think a lot of these things culminate, as we talked about in the Econ show, showing a downside trajectory with import prices being fairly flat versus estimates, but again, export prices continuing to remain elevated. All the while, when you look at sentiment in the University of Michigan, expectations have gotten much worse as current sentiment has recovered. The biggest piece, especially when we start going through CPI, which we're going to talk about in a minute, is going to get worse only because when you look at that flexible versus sticky, going back to the increase in diesel and gasoline prices. So just to put into perspective on those real average earnings, the trajectory is still to the downside, and with inflation now re-accelerating to the upside on both the flexible and sticky side, we're going to see more pain to the consumer. And when you look at core CPI, as we've been talking about, the Cleveland median CPI and Cleveland trimmed mean CPI are good bellwethers as to where is core CPI going to go. And given Cleveland median at 7%, trim mean at 7.3%, and core CPI still only at 6.7%, the trajectory is still going higher, is still moving up. And you can see just how much pressure there remains across every metric that the Fed uses. And as we said last week, as we said in the Econ show, and as we talk about in the insights, if you were to use the old metrics, we're closer to about 17%, and that shows just where a lot of that growth continues to go. Now, as we've been discussing, we expected commodities, if you look at commodities or durable goods and services, we're going to meet in the middle. There was going to be this merge in terms of pricing, with the idea that services was going to come up, durable goods were going to come down, and there was going to be this convergence. And here we are. We're now at that crossing point. The problem is, back to what we've been saying, is services is stickier. So when you look at that sticky inflation, that's when we now turn to sticky versus flexible. You can see sticky inflation moving at a very aggressive rate. We do not see that changing. If you look at core CPI is still above sticky, trim mean, median, all of this is going up. And while flexible has come down, it's still at the highs not seen since the 1970s. And then if you look at diesel and gasoline prices, because remember, this is September data. September saw a decline in diesel, a decline in gasoline. Now you're seeing acceleration in diesel and acceleration in gasoline prices, which is going to push flexible back up. All of this, again, is just going to pull that core inflation higher. and increase the pain, because as that is going up, you're seeing wages slow, you're seeing real wages slow, maximizing that pain, and again increasing our view or confirming our view that retail sales are really going to roll over. And here you can see again they've plateaued. So it plateaus first, then it starts to roll over. And when you look at the trend on the monthly change, you can see the trend has been slowing. And now this is where we do expect to see that really start to roll over into October, and then again get worse through the remainder of the year. And all the while, the dollar continues to move higher, and the U.S. dollar is at the strongest relative to the Japanese yen since 1990. And again, the market is putting pressure on the BOJ, betting that they're going to adjust the yield control curve. And when you look at how PPI accelerated, as we discussed in the Econ show, and things continue to go up, this is going to be a huge move and something to watch when you look at how are we going to see some pivots, especially in the Asian markets. So that's what we have for you today, trying to keep it a little bit shorter and let everyone get to their weekend. Hopefully you have some exciting plans, and we hope this was helpful. Again, if you have any questions, find us in the comments section on Twitter, and have a great weekend. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.